Welcome to the Daily Brief, where I'll go over the action in the market for Wednesday, February 22nd, and then we'll see how things are looking for Thursday, February 23rd. We had a little bit of a reprieve from the fall that we saw in Tuesday's session, enough to kind of slow things down as our charts were suggesting, but we still had a down day. We're still turning more negative. However, since we didn't get much of a bounce, we're now into a short-term oversold condition. That may help to produce some kind of a bounce, but if that ends up happening, we'll watch things on Thursday to see, does that change things back to more positive, or are we just working off some of this short-term condition before we get set to go lower? So let's go back and talk about what happened. Right at the open, we had a slightly higher open, but that didn't last very long. Prices dropped down below the unchanged level, so they went negative. As the day went on, we rebounded and got back above the unchanged level, but then we hit resistance right at the daily pivot at 4,015. Prices then declined from that level, and that was about the time that the FOMC meeting minutes were released, and that's being taken more as negative, even though nothing new was really stated in the minutes. We went back down to S1 at 39.78, and then we closed just above S1. We were down 0.16%, and volume still continues to be below average. If we have an up day or a down day, we're still seeing that trailing off of volume. The technicals, as I stated, are more negative now, although we're short-term oversold because of this inflation and interest rate environment that the market's been in for pretty much a year now. That's feeding over into the earnings per share as well as valuation concerns for companies. We do have the geopolitical concerns that are going on right now. Earnings season's kind of coming more towards the end, but we're still getting reports out. And then the debt ceiling just has not been dealt with yet. Here's the intraday chart showing how we had a little bit of a higher open, and then that didn't last long, so we dropped down below the unchanged level, went negative, built a bit of a base here. We didn't get down to S1. That came later in the day. We saw a pretty nice little advance going back up above the unchanged level, but this dark blue line here is the daily pivot. We hit that, stayed along that level for a while, and then dropped back down. We went down almost to S1. We really didn't hit S1 until we got into the last bar, which each one of these bars is 10 minutes, and then we closed up off of S1. What are some comments that we can make? Talking about the FOMC minutes that were released, it said that substantially more evidence of progress across a broader range of prices would be required to be confident that inflation was on a sustained downward path. That just means that they're not really happy with what they've seen so far. It's getting better, but it's not where they want it to be. And then, as I stated in some previous videos, there were a couple of participants who wanted to raise rates by 50 basis points instead of the 25 basis points that they did raise the rates. St. Louis Fed President Bullard came out, who's not a member voter, said that he thinks the Fed funds rate should be at least at 5.375 before the Fed pauses. We're at 4.75 now, so we still have a ways to go. Also, in that same general area for the economy, it says that a lot of economic data that's been received since the last FOMC meeting suggests that the Fed is likely to take rates higher than previously expected and keep them longer at these high levels than previously expected. That's kind of the new scenario that's coming out. The market may push back against that. We get one economic report that comes in weaker than expected, and boom, they're back to the scenario that we're going to start seeing the Fed pause their rate hikes and then start to lower them. We might be stuck in this kind of an environment for quite a while, and the market doesn't like that, and they've been pushing against that for almost a year now. On a short-term basis, we have our McClellan oscillator still looking extreme negative. The stochastics, the Stochc RSI, the Williams percent R, and the force index. These are all short-term indicators, and they're all giving us extreme negative readings. On an intermediate-term basis, we have one of the PMO studies that I'll show you, and the CCI 14 as well as the 20 period. The dollar advanced and interest rates were down, although interest rates didn't fall by that much. We still have all of our yield curves that remain inverted. Sentiment is unchanged at 63, so that is positive. Although we're coming from a high level and it's declining, even though we look at this as positive, it has more of a negative flare behind it because we're coming down. I'll talk about the economic reports on the next slide. Our trend is negative. The red line crossed. We've had the second day now where we've switched over to that new stance with our trend. It is weakening because we're below the moving average, but we're still above 20. Our bias remains negative. That's just one day. And then our momentum, looking back at the last 2, 3, 4, 5 days, our momentum continues to be negative. We just had one report that came out that didn't really have much of an impact. The weekly MBA Mortgage Applications Index, it came down 13.3%. Last week, it was down 7.7%. The Ulcer Index is starting to turn back up. We've come back up to the moving average. This suggests that fear is starting to increase in the market. It is not extreme by any means. We could go a lot higher with this indicator, but it is starting to pick up this fear that is coming back into the market. The VIX actually ticked down a little bit, even on a down day on a closing basis, and we pretty much matched the bar from the previous day right now. We're looking to see, can we break out? We did make a higher high in Wednesday from Tuesday, but we'll want to see this go back up if we continue to fall from here, since the VIX spent a lot of time being very complacent. Here's the VIX of the VIX where we declined based on the line chart, and we also came down on the bar chart showing how volatility did decrease slightly. Here's the ADX showing the condition of our trend. We're below the moving average, it's declining, and the ADX is just about getting ready to cross below 20. The red line's on top, and the green line is down below. One more day, and we'll probably switch into a trendless environment. The daily chart showing how the pivot level is so far holding up. We came down to the 50-period moving average, bounced up off of that. So some support continues to hold. And this pivot level, we closed right on that. At the bottom, that's where volume dropped below average and has been below average for a number of days. Looking at our stochastics, on the short term, we're extreme negative. Intermediate term, extreme negative. We're going lower with the long term. So this chart is negative, but short-term overextended to the downside. The Stoch RSI remains extreme negative, as does the Williams percent R. The Force Index continues to be down at the lower Keltner band, and that is extreme negative. We've fallen pretty far, pretty fast. The CCI 14 and the CCI 20 remain extreme negative. The PMO study that I was referring to, the PMOs that are rising, we've slipped below this 20 level here. We're declining with the buy signals and could go into extreme negative territory, where with the percent of PMOs that are above zero continues to decline. The Swinland Trading Oscillator based on price and volume are negative. The BPI continues to tick down. It's still positive because it's above 50, but it's coming off of an extreme positive reading, so this is more negative. The other bullish percent index we look at, the BPI for the NYSE, is now dropping below what had been a breakout level. The Chaikin money flow continues to be positive but showing weakness. The balance of power is just crossing below the dashed line. Above the dashed line is positive, below is negative. The TTM squeeze starting to switch over negative. It's turning red. The go-no-go system remains neutral with the lighter colored blue bars. The CMB composite index is still getting down to this extreme negative reading. On a short-term basis, we fell through this fib retracement at about the 4007 level. We're currently in no man's land, which is where we were yesterday, so nothing was decided on that. Longer-term fib chart, we're below this 38.2% retracement level and still in no man's land. And then longer term, we fell below the 4020 level, another Fibonacci retracement level, and we're in no man's land currently. We came down to the 50-period moving averages. The red one is the simple moving average. That's likely what gave us a bounce since millions of investors use that. And we also came down to the exponential 100-period moving average and then bounced up off of that. So here's our moving average tree. We're dropping down below some of the shorter term moving averages. We're wondering if these support levels will hold. Will we get a bounce from that, or are we going to continue to go back down? Or if we go into a trendless environment, are we going to chop sideways? The Elder Impulse system for the S&P 500 remains negative. McClellan oscillator, and I'm trying to point out some divergences here. The S&P was going up, but the McClellan oscillator was not matching that. Now, some of that is done because of the way this is calculated. This is moving average based, and so when you recalculate moving averages, those figures that are used in the calculation are shorter to now, so you can't help but get a divergence. A lot of people do really read into this and go, oh yeah, look at this. We're making a higher high with the S&P and a lower high with the McClellan oscillator. Oh, that means trouble. Well, we also saw a negative divergence going into February where the S&P was going up, but the McClellan oscillator did not match that. However, right now what we're looking at is that we're extreme negative with the McClellan oscillator. The summation index based on price and volume are still negative and declining. Not seeing really anything with the new highs, new lows, so we're flat with the 5 period and flat with the 10 period. We're seeing a little bit of a decline with the advanced decline line based on price and volume. We're below this zero line with the advanced decline ratio. We're still positive with the accumulation distribution, but we're coming down to this moving average. Volume is still below the zero line, and the histogram, even though it's ticking back up a little bit, we're still dropping off with volume. The diamonds are still negative, and the Qs are still negative with the Elder Impulse. The praying bottom fisher is still generating a buy signal, but it kind of seems elusive right now, but we still want to make note of this. The FANG stocks, this could be positive. For the first time in an awful long time, we're looking at a potential golden cross. This is Facebook, Amazon, Apple, Netflix, Google, and now they've changed the acronym, and you can't even pronounce it anymore. They've added some more stocks. I just continue to call it FANG, and we're looking a little more positive there. But after we really broke out, we're starting to come back down. So we'll want to see if this is some kind of a fake out, if we see a continuation of weakness in the FANG index. Looking at some of our scenarios, just to update you on this, they're not positive right now. We're declining below zero and even falling further based on price and volume. The 10-day average of the S&P 500 highs minus the lows, we're still camped out at this extreme positive land here. It just hasn't changed all that much. Because we've been chopping around so much, we have a 10-day average, and we're going to need to see some kind of a breakout or breakdown before we see this indicator fall below being extreme positive. The staples to S&P 500 ratio continues to be viable because we're still far away, but this spike is starting to come back up. What is the outlook for Thursday? The technicals are negative, but we are now short-term oversold. We have weekly jobless claims coming out and the second estimate of the fourth quarter GDP. Even though this is a really big report, this may not be all that influential since this is the second time we're getting this report. We'll want to keep an eye on this. If we get something drastically different, that could really move the market. All the listed geopolitical events, Russia, Ukraine, and then China saying they may step in and do either good things or bad things. The inflation and interest rate scenario continues. Earnings season still goes on. If we get any more Fed speak, we'll just be on the lookout for that. And then if there's any kind of change in the debt ceiling, but that seems to be way off the radar for most politicians currently. Looking at the Stock Traders Almanac statistics for February 22nd, we're neutral to positive pretty much across the board with the Dow, S&P, and NASDAQ. And then all the other statistics that we go through periodically. We still have this speech coming up on Friday at 10:15 a.m., just to be aware of that, by Governor Philip Jefferson. Our scenarios, we're going with the down scenario. Now, we could switch over to trendless if the ADX drops below 20, but on a short-term basis, we are oversold. We can't go with the up one now, even though we are oversold, which may produce some kind of a bounce. And we can't really go with the sideways one right now because even though the ADX is weakening and we're just getting ready to drop below 20, we haven't dropped below yet. And overall, the ADX is negative with the red line on top. So our conclusion, the S&P is negative but oversold in the short term. Intermediate term is negative, seeing a few indications with the CCI, but not a lot of oversold conditions yet. And we're still positive in the long term as long as we are above the 200-day simple moving average. Thank you. I hope you found this helpful, and I will talk to you in the next video.